tell me about the name. You didn't call it a bull or a bear or any other bigger animal.
Yeah.
You went with the sloth. Tell me about the sloth.
Yeah, so why the sloth? So why is the sloth my investing spirit animal? I really dive deep into Warren Buffett's shareholder letters. And there's one in particular, his 1990 letter to shareholders. And it's this great quote. It's lethargy bordering on sloth remains the cornerstone of our investment style. So what it essentially means for the layman is that, it's quite counterintuitive in reality, and I'll touch more upon that in a moment. But, a less is more hands-off couch potato approach to investing is one that pays great reward, reaps great dividends, for example. And that's one of the great things I love about this style of investing, because you think about most realms of life, it's effort, it's activity, it's energy that brings with it great reward. And but one of the great things about investing is that, so much evidence shows that a less is more hands-off approach brings with it so much great reward, brings with it success to investors. That is why the sloth is my investing spirit animal, because unlike most realms of life, it's inactivity that brings with it great success within the domain of investing.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is R.P. Stevens. He's the author of the Sloth Investor book, the host of a podcast and a YouTube channel with the same name. He's a personal finance author, YouTuber. He's committed to educating people about how to invest their money in a common sense, sloth-like manner. R.P. firmly believes that the slow-moving, inactive sloth is the best animal to characterize successful investing. After we stopped recording, he shared with me how he received a personal note from his proofreader who read the book. Instead of a harsh feedback that he feared, he learned that she never thought investing is for her, and now she wants to become an investor herself. To me, it's the best testament to what this book can do for many listeners curious to embrace investing as a lifelong pursuit. It was a late night recording for RP, early morning for me. We kept talking long after I hit stop. I greatly enjoyed this conversation, and I hope you do too. Please help me welcome R.P. Stevens. Hello, R.P. How are you? It's so nice to see you.
I'm fine, thank you. How are you? Thank you for this great invitation, and I'm looking forward to our forthcoming discussion.
Well, I loved your book. I sent you an email and I shared my thoughts about your book, and I like the image of a sloth, and we'll talk more about it, but I found I found it very relatable because that's how I think of investing. I feel like we need to slow down to capture the long-term upside in a world that's speeding up too much, in my humble opinion. So I'm very curious about your thoughts on it. But before we jump into the book itself, I do want to ask you about those early days, your childhood upbringing, and how you think that time shaped you and your interests, your career, and even this particular way of looking at investing too.
Yeah, great. It's interesting, actually. I actually grew up in a family of non-investors, perished of thought. I was not someone who kind of even had a particular interest in investing. So I guess I'll get back to that in a moment. But in terms of personal finance, from a young age, my mum and dad, particularly my mum, encouraged me to save money. So that was always, first and foremost, very important to me in terms of money sense. But in terms of investing, I mean, this is not something that my mum and dad ever spoke to me about. And if anything, if I ever came across the world of investing, it was through, just occasional kind of, news items on national television, the BBC and so on, ITV in the UK. It may have been a particular time when there was volatility in the stock market. And I, heard a few sound bites here and there. And I saw the, flashing neon lights of a trading floor in the Wall Street Stock Exchange. But I just didn't really have any particular interest in investing so much. And I guess it wasn't really until I spoke to my father-in-law, John. He's the one that really started to kind of speak to me about investing. And it's through him that I learned a lot more. But if I'm honest, even after speaking to him, I was a little bit unsure because I thought, the wrong with investing, is it for me? Isn't it just for the professionals? Isn't it just a numbers game? Isn't it a bit too complex? So I guess I took a bit of persuading. I guess he, gradually wore me down and I started to become more interesting. But no, certainly from my early years, investing never really entered, my mindset. More so when it came to personal finance, it was saving money. That was definitely important, but investing, not so much until I met my father.
So when you think of investing in those early days when you got into it, what was the draw? What attracted you to it? Why investing? Why not completely ignore that part of the universe?
Yeah, I guess that's a great question. I guess it's through speaking to my father-in-law, John, I started to learn a lot more about, I learned a lot more about compound interest, the wonders of compound interest, what it can do for you. I think he was definitely someone that, showed me one of those typical graphs. If you invest, £100, let's say $100 in the US this month, then again the next month, and if it grows by 8% per year, he's certainly someone I think he took out, opened up a Yahoo Finance app and he showed me one of those graphs and I was pretty astounded. Like, okay, that's pretty good. That's pretty, for that relatively small amount, it'll grow by this amount. So it was pretty interesting. And I think I've always been someone that's really been drawn to that concept of opportunity cost. Even to this day, I still think, oh my gosh, I've just come back from a trip to Europe where I've been promoting a book. And, I woke up quite late, so I really did. I guess I'm still suffering a bit from jet lag. And I thought to myself, oh man, if I'd woken up a few hours early, I was quite hard on myself. Could have read that book that I bought on holiday, one of many. And I do tend to be someone that really thinks about the opportunity cost of the choices I make. And back then, when my father-in-law spoke to me about investing, it did make me wonder about, well, gosh, that was in my late 20s, I want to say. And the years that I hadn't invested, I was looking back and thinking about what I'd missed out on. So I guess it was a case of thinking about, wow, for someone to go through their entire life and not to invest our hard-earned income, that would be, I don't want to say a tragedy, but that would be, an ill-informed decision, put it that way. So I think that's really something that really is really key to me, just making sure you don't miss out on opportunity cost. And it's critical to invest. You want to kind of optimize life. You want to optimize your life fully for all those experiences, all those endless possibilities that could come up in the future. So yeah, that's what I'd say.
I like that perspective. It sounds like minimizing regrets, not sitting there.
Yeah. And I guess it's funny actually because not so much anymore. But I know I'm someone that's a fan of Warren Buffett's shareholder letters, but Jeff Bezos. So Jeff Bezos, on an annual basis, he would write these great shareholder letters for Amazon, and this is something that he came up with, isn't it? I think it's called the regret minimization framework, and that kind of ties into as well. Had this conversation recently with my brother-in-law about writing a book and, the rationale for doing so and the ambition to doing so. And I remember speaking to my brother-in-law and just saying, I didn't want to get to the age of 70 and to have had that regret, to think, oh, what if I'd written a book about investing like a sloth, my 5 bedrock principles, and that's why I wanted to get out of this. So I guess, minimizing regrets is a key factor for why I invest. Absolutely.
I do want to ask about the sloth and how it came about, but I'm very curious about the relationship with money. Do you have some memories from childhood? How did you feel about money, or how did your parents make you feel about money in some way? Do you have some memories of that?
I guess my mum always very much reiterated the importance of saving money. So back then, it's funny actually, at the dinner table tonight, my wife and I were speaking to our son Leo about pocket money, and he's getting a little bit older now. He's going to be 10 in a couple months' time. The chores we expect him to do, nothing too strenuous, but setting the table and putting shoes when you come back from play date and so on. And I remember my mum vividly talking to me about, saving money. I think the going rate back then in the UK in the early 90s was £5, and I was lucky then. It always happened to be, 5 £1 coins. It wasn't, a £5 note. It always happened to be 5 £1 coins. I could kind of siphon off some coins for saving, and I could then maybe spend a little bit, perhaps on some comics and so on, maybe a few sweets. But I remember my mum always stressed the importance of saving money to me. And again, it wasn't really so much for, future investment. My mother and father, fortunately, were not kind of investment savvy, if you like. But, very much from a young age, I was certainly told, particularly by my mother, about the importance of saving money. I guess saving money for a rainy day. There's a whole, is it Aesop's fable, the ant and the grasshopper? So saving money was definitely first and foremost part of my kind of like early personal finance literacy, if you like. Yeah.
When I'm listening to you, I'm thinking in terms of investing, you're already working, earning an income. Why not have your money work for you, right? That's what I'm hearing.
Yeah.
And then over a few decades, it can make a huge difference. So you could have some choices, and you might have those choices sooner. And I'm sure we'll talk more about it, but it gives you this wonderful optionality. And sometimes, sitting down with clients, I work with wealthy individuals, and the fact that the money is even there, waiting, untouched, gives them an immense peace of mind, even if they might not use it, and just its presence helps. I'm sure we'll talk more about that kind of psychological impact. But I do want to jump into the book itself. So the book is called The Sloth Investor, Simplifying Investing for All. And I love that. I gave a TED Talk, Great Investor in You, and I wanted to convince people to invest in whichever way they want, but just to become business owners through the stock market. But tell me about the name. You didn't call it a bull or a bear or any other bigger animal. Yeah. You went with the sloth. Tell me about the sloth.
Yeah, so why the sloth? So why is the sloth my investing spirit animal? Well, I guess after, speaking to my father on investing, he was a catalyst for me. And after speaking to him, I read several personal finance books. I really dived deep into Warren Buffett's shareholder letters. And there's one in particular, his 1990 letter to shareholders. And there's this great quote. It's lethargy bordering on sloth remains the cornerstone of our investment style. So I say again, lethargy bordering on sloth remains a cornerstone of our investment style. So what it essentially means for the layman is that, it's quite counterintuitive in reality, and I'll touch more upon that in a moment. But, a less is more hands-off couch potato approach to investing is one that pays great reward, reaps great dividends, for example. And that's one of the great things I love about this style of investing, because you think about most realms of life, it's effort, it's activity, it's energy that brings with it great reward. If you're learning a foreign language, perfecting your golf swing, if you're kind of trying to kind of improve your serve in tennis, for example, it's energy again and again, activity. And but one of the great things about investing is that, so much evidence shows that a less is more hands-off approach brings with it so much great reward, brings with it success to investors. And so that's why, for me, the sloth is my investing spirit animal. It's fun, actually. Like, I've actually got here a little bit of a surprise for you. I've actually got a bar of soap as well. And I'm going to tie in to Warren Buffett as well. Cannot remember exactly which shareholder letter it was. It may not have even been a shareholder letter of his. But he's got this great analogy as well to a bar of soap. He makes the point that kind of the more you tinker of your portfolio, the more it's likely to perhaps get smaller, if you overanalyze, if you overthink your composition or the stocks you own and so on and so forth, it's likely that could have a detrimental effect on your portfolio. And likewise, the more you tinker, the more you play with soap in your hand, the more you use it, the smaller it becomes. So again, I just think that is why the sloth is my investing spirit animal, because unlike most realms of life, it's inactivity that brings with it great success within the domain of investing.
So I have to mention this. I saw a sloth in nature at some point in my life. And when I walked away after watching him barely move and barely acknowledge anybody's presence, I told my wife, I wonder if we're not watching, do they actually move really fast?
Yeah.
And they're just tricking us.
Yeah. They're amazing creatures. It's funny actually because since I introduced this whole notion of the Sloth Investor, I've been active on Twitter, I guess now X, YouTube, and LinkedIn, and so on. And it doesn't seem to a week that goes by when I don't have someone give me a sloth fact about how many years they're expected to live. And one fascinating one that I learned actually while writing a book is that a sloth, their default grip is it's a tight grip. It's really hard for them to kind of like let go. And I think that's again another great analogy for investing. Particularly, on the day that we're kind of recording this and the week we're recording this, there's a lot going on, a lot of volatility and so on and so forth. But that kind of like default strong grip, a tight grip, I think is, again, another great analogy for investors. Again, ties into being headstrong, which I know we'll discuss in a little while as well. But I love that as well. But yeah, I've learned a lot about sloths as well during the production of my book. And yeah, it's been great.
But the word sloth in your book stands for something. Do you want to share what the different letters mean?
Yeah, so I became such an investment geek many years ago after speaking to my father-in-law, John, and reading Warren Buffett shareholder letters and many personal finance books. And so I guess my 5 bedrock principles represents a synthesis of all that I've learned about investing. So each of the letters in sloth spells out one of those bedrock principles. So S is simplicity, L is low fees, O is own the world, T is time, and H is headstrong. And those 5 bedrock principles really do, for me, represent the synthesis of all that I've learned about investing over the last 10 to 15 years. And for me, if anybody asks me, what is the core of my book? If I just had to read one chapter of your book, if I'm in a rush, what is the one chapter? It's certainly chapter 5. That is really the core. That's the spine of the book. Is the longest chapter. And in chapter 5, I elaborate upon each of those 5 bedrock principles. Yeah.
The last one is headstrong. I have to ask about that one.
Yeah, headstrong. Yeah, I mean, at the beginning of Headstrong, the section on Headstrong, I mentioned the fact that, when we think about an investor's worst enemy, all they need to do is actually look in the mirror. It's ourselves. Of course, many of your viewers will no doubt know that I think undoubtedly the most successful personal finance book in the last few years has been The Psychology of Money. The Psychology of Money by Morgan House. I'm a great fan of that book as well. One of my favorite personal finance writers. He's absolutely right to use that word psychology because I think, again, this is one of those interesting points about investing is that what deters many people is that they think, oh, it's a numbers game, it's complex. I need to have a sophisticated understanding of mathematical algorithms and so on, or I need to have some of my family who can help me, or I don't have that background. But first and foremost, if you have, a calm temperament, if you have, a relatively good understanding of, cognitive biases and how they may affect you, and if you can just remain calm, okay, that will serve you very well when it comes to investing. Yes, those other principles come into play as well, low fees and a commitment to a long-term mindset, but remaining headstrong through the thick and thin is going to prove critically key for your success as an investor.
You touched on it before, but I do want to ask about the obstacles that people face when they want to become investors. Can you talk about these? It's not that easy to get into it if you want to do it the right way. And here I want to distinguish between people that are trading stocks in an app daily and people that actually want to become long-term investors.
Yeah. What deters people from investing? Well, I guess speaking from personal experience, I think something that can initially deter people is this notion of in-group bias. And I think our upbringing has such a great role upon us. So I think about myself. So when my father-in-law, who I've mentioned a few times now, when he was speaking about me about investing, very much in the back of my mind, I had my mother and father, and I had them. And there were a few occasions growing up when they said, oh, stock markets, gambling, don't touch with a barge pole, comments, phrases like that. So I was very much someone who thought, I'm never going to kind of enter this kind of like heady world of investing. It's an off-limits domain for me. So I think in-group bias has a role to play. And in that respect, I think it's very important to be open-minded. And again, to what you said before, to speak to what you said about optionality, to recognize the great optionality that comes from investing. I think there's, in that respect, I think there's imposter syndrome as well linked to that, whereby some people think that with no prior experience, that investing isn't for them. I also think something that deters people is the fact that they're just not taught about it at school. So this is something I'm also passionate about as well. I'm passionate about going into kind of like secondary schools, colleges, universities, speaking about investing as well. So I just feel like that is something that too many young people, whether you're in the States, Canada, UK, wherever you are in the world, too many people are leaving, school, entering a workplace, and just not even having a basic understanding of the stock market, compound interest, having no concept of Warren Buffett, let alone someone like Jack Bogle, who I'm a great fan of, and we'll get to later. But I think that's something as well. And going back to what you said about trading as well, it's interesting because I think in some senses in our contemporary world, we've been conditioned to immediate gratification. Speaking to my son and daughter about this a few weeks ago on a holiday, and we would talk about the fact that, when my wife and I were growing up, we'd want to watch a show. Let's say it's Friends. In the UK, it was Friday night at 9:00. And then we'd have to wait one whole week for the next episode and so on and so on and so forth. Whereas, of course, with Netflix now, we can binge watch our favorite show. Likewise, when it comes to, downloading your favorite book. For example, The Sloth Investor, it's a great book. That can be downloaded Apple Books, Amazon on your Kindle and so on, Uber. All of these applications have spoilt us, if you like. And I think there's that tendency with many people when it comes to personal finance to kind of trade. And you even notice that, many platforms in the UK, many investment brokerages have that word trade in the title, which I find particularly fascinating. And I always talk to people about, if you were to tally up the amount of times you see the word trade in a brokerage advertisement and the word invest, there's quite a disparity there. Of course, you're going to see trading more. And of course, it's fees that contribute to their overall profit. But I think fundamentally, investing is key. Investing for the long term, not looking at your portfolio on a daily basis. It's decades, not days. So, I think there's many things that kind of deter people from investing, but certainly short-term mindset and those cognitive biases, in-group bias, like I mentioned as well just a moment ago at the beginning.
In my mind, the big revelation was seeing investing as business ownership. I get to own small pieces of businesses. And whether I select the 30, 50 on my own, or if I buy an index, at the end of the day, I get to own some wonderful businesses. And that really spoke to me as an idea that I don't have to be the one inventing them. I don't have to know the founder. I don't have to be invited to the right dinner party. They are all available in the stock market. And the stock market doesn't care if I'm young or old, experienced, not, what I look like, what's my gender. The stock market is there open. You show up, and here I have £100, €100, $100, and I'd like to become a partner in all those businesses. And there's a way for me to do it. And I'll be treated fairly and equally as a minority and very, very small shareholder at the beginning as anybody else. And that's not a given, but it's pretty well established in some bigger markets out there that you're treated. There are systems and regulations put in place to treat you as well as anybody else who is an investor. So that's something that really spoke to me.
Yeah,
you brought up some giants in the world of investing, and you talk about them in the book quite a bit. Who are the big individuals, stories in the investing world that influenced you?
Yeah, so earlier in the book, I talk about my kind of fictional, five-a-side soccer team. So I'm a major fan of soccer, football in the UK, and very much, many football fans. We love this whole concept of five-a-side football. So I devised this list of 5 international fantasy investors. And my first and foremost, to captain my team, if you like, is the late great Jack Bogle. And I'm sure you'll be aware, but some of your listeners may not. But Jack Bogle was, of course, the founder of Vanguard. And Jack Bogle is really the person that helped to really popularize this notion of the index fund. So he really is numero uno within my field of great investing giants. I just think that, oceans of ink have been spilt upon, Warren Buffett, and rightly so. But I think still not enough has been written or said about the legacy of Jack Bogle. And we're starting to now get more books written about that. I guess most notably The Bogle Effect by Eric Balchunas, and Trillions, I think, was written by Robin Wigglesworth, came out a few years ago. But Jack Bogle, just to me, in terms of that kind of invention of the index fund, is definitely up there. I think what Benjamin Graham has to say as well about market psychology, he's definitely someone up there as well. So his notion of Mr. Market, somewhat, so Mr. Market is his kind of conception of the stock market as being this kind of irrational Dr. Jekyll and Hyde character who kind of, seems to be, behave in a savvy, rational way in some days and entirely irrational the other day. I kind of make a similar comparison to kind of a temperamental toddler. I've got 2 children, one who's 6 and, one that's 6 and one that's 9. Both those kids, of course, have gone through the toddler stage. And so that's why I think that whole conception of Mr. Market spoke to me. Warren Buffett, of course, is tremendously a key figure for me. And what I love about Buffett is the fact that, yes, he has been incredibly successful in terms of his style of investing. But what he has to say about index funds and the fact that he really is such a firm advocate of index funds, and the fact that when he passes away, he wants, a large percentage of his kind of estate to be placed simply, in a Vanguard S&P 500 fund. I love what Buffett has to say about index funds. And I guess I'll mention one other, and, that is Morgan Housel. So I think Morgan Housel might seem a bit of a cliche choice, but he is just such a fantastic investment writer. Not only to Psychology of Money, that's become such a well-established and, massively selling book, but also his time at the Motley Fool. When he was there, he wrote so many great articles, and I mentioned several of them in my book. But, those are the 4 key figures for me that are kind of like titans, particularly Jack Bogle at the very top.
I'm a big fan of all the characters you mentioned, and Morgan Housel has done an incredible job explaining some really tricky topics to all of us in a way that's very relatable. I think he's a wonderful storyteller, and I've enjoyed his writing for many, many years. I want to ask you about what I thought was the key idea here, and you talk about the time in the markets. The more time we have or can have, the better. And I love that idea, and that's how I operate and that's how I think. But can you talk more about it? Why it matters to have time in the market?
Yeah. So I make this point in the book that, investors need to be, Jedis of patience. If you think about the success that you've had in life, whether it's someone who is, learning to play a musical instrument, whether it's for, revising professional exams, whether it was for, becoming, a more skilled basketball player, perfecting a golf swing, and so on and so forth. It's time. These things don't, come overnight. I don't want to sound cliched, but it is so incredibly important to kind of recognize that in the stock market, over a relatively short time period, there can be volatility. Over a 1 year time period, the stock market might go down. It could even happen over a 3 to 5 year short period. And for me, these are relatively short-term time periods. Now, someone else might say 5 years. That's a long time in the stock market. I don't think it is at all. So, if you're investing for decades, the more you invest, the more it is that you're likely to achieve a positive outcome for your portfolio. So, and again, I think that does come back to, I mentioned it briefly before, but our contemporary world and what it's done to us. It's great when we think about FANG. They're kind of like the 5, figureheads for the stock market for the last 10 to 15 years, Facebook, Apple, Amazon, Netflix, and Google. And no doubt they have been great stocks to own. But again, to what I said before, I think so many of these companies have kind of conditioned us to immediate gratification, to wanting things instantly. And we just need to take a step back and to recognize that, if we look into it achieve success in whatever domain of life, it's going to take time. It's going to take patience. And it's having that wisdom, really. So, when I present my investing workshops, I'm not particularly looking for people to leave the workshop as experts. That's not the case. I'm not going to expect people to go home and to number crunch stocks and to know how to use a P ratio, PEG ratio, and so on, a stock-based compensation. But what I'm looking for them to leave the workshop with is wisdom. It's wisdom more than expertise. And it's the wisdom to recognize that it's patience. It's a long-term mindset that is so critically key. And I mentioned someone else in my book as well, this investor called Grace Grunner, and she was someone who invested decade after decade after decade. And you think about, she started investing in the 1930s, and she, would have invested through World War II, the Cuban Missile Crisis, the Middle East oil crisis, 9/11, and so on. But yet, she achieved successful results. So I think for me, I don't want to single out, one or two, bedrock principles, but time is for me one of those top one or two bedrock principles. It's so critically key. Certainly my, top two or three, I'd say critically key.
I really like that idea because in my mind, when you think of the market, people say it's very competitive. And I think it's true to some extent. So if you and I were trying to play a game where, let's say, the market will close up or down today, and we bet $1, right? It's a 50-50 chance on any given day, statistically speaking. But if you start extending that horizon, and you know that very well, right? That over 5 years, 10 years, 20 years, the odds of actually making money improve dramatically. And I don't remember if it's over 20 years, it's close to 100% that you would have made money.
That's right. And I can remember, sorry to interrupt briefly, like I remember just someone mentioned to me a while ago, but RP, invest, it's just like gambling. And this is a point that I make in my book about gambling. So the distinction is that, when it comes to, gambling, the house is always going to win. But the difference really fundamentally is time frame. So when it comes to a field of investing, you're very right to bring up those figures, 5, 10, 20 years. The longer that you remain invested, the much more likely it is you're going to get that positive return. So that's why I think it's critically key to make that distinction between investing and gambling. It's really important. Hey, sorry to cut you off there.
No, I love that thought. In my work, I call it an infinite investment horizon. I'm so audacious that I call it infinite. And I work with families with multi-generational wealth. And when we sit down and talk, I realize, and I bring it up, that when you really think about it, you have an infinite investment horizon. This is the money that you might use in your lifetime, but it's here to serve the next and the next and the next generation. In an ideal world, you would like to invest it in a way that it lasts. Hopefully forever, that there's always something for the next generation to start with. And I like this idea that each generation should not start with zero. What can we do so that each generation doesn't have to start from an absolute zero, that we all build on something? And I have this image of knowledge, right? Like you and I sitting down and we're talking about the giants. We're both sitting on shoulders of giants right now, right? Whether it's Buffett, but Buffett is sitting on Ben Graham's shoulders, and Ben Graham had his inspirations, and on and on and on. Ben Graham actually sourced his inspirations from a wide from philosophers too. And it's fascinating how with knowledge we accept that you and I show up at school, you're a teacher, and you know very well that we're building on something that was built before. But with money, somehow each generation starts with almost nothing. Like so many people will inherit very little or nothing. What can we do, right? And that's been my obsession and curiosity, having worked in this field, in this particular aspect of it. How can we have something to start with? What can we do so that the next generation can have something to start with? And that's the infinite open runway.
Yeah.
I'll ask you in a bit about the kind of money, the capital itself. You have thoughts about it, but I'll come back to it in a second. But I do want to ask you, related to time, you say something that really struck a chord with me. I think it's very, very important to mention that investing is 0.01% buying and 99.99 waiting. And I think it's so crucial to highlight that because we love the action, but the action is such a small part of what is happening.
Yeah. I mean, again, I think this is something that's caused me to become so ceaselessly fascinated by investing is that there are just so many counterintuitive points about investing. And again, it's one of those points as well, action. I was speaking to my son earlier, we just returned from a holiday in Europe, about handwriting. So my son needs to work on handwriting and so on. So he's going to have to take action, needs to practice to improve. And again, it's like most walks of life. You need to take action to get better, whether you're perfecting your tennis serve, your golf swing, and so on and so forth, learn a foreign language. And I think, again, we're just prone to take action. We're prone to take action to get better. But it's funny because I actually came across an article a few days ago about alternative titles for books. It was, alternative titles for Lord of the Flies and George Orwell's 1984 and so on and so forth. And, it got me thinking about what would be an alternative title for the Sloth Investor, and I got thinking about that, and I love my title. I love the whole concept of Sloth Investor, but one of my alternative titles might simply be, get on with your life. Get on with your life. So, not to worry about how the stock market is doing on a daily basis, not to be kind of worried about the geopolitical strife that we have, whether it's in the Middle East, Ukraine, and so on and so forth. And I think in this regard, something that has really kind of influenced me, there's a great book that I read by the late, great Hans Rosling, who is a Swedish data scientist. He wrote a fantastic book full of data called Factfulness a few years ago. And in this book, in one particular chapter, he talks about the disproportionate amount of coverage given to negative events within the news, whether it's geopolitics, whether it's disease, whether it's starvation, so on. But the simple fact is that over time, it's gradually the world has improved. We don't hear so much about the positives and so on and so forth. So I think that is something as well. I think if I were to come up with kind of an alternative bedrock principle, or a sixth bedrock principle, if you like, it would be optimism. It's the optimism that no matter how the stock market is doing today, this week, next month, next year, you just need to be cognizant of the long-term trend, like zoom out of that stock chart, simply zoom out and you take a look that yes, there are ups and downs. And yes, when a stock market goes down, it falls down like an elevator, absolutely. But then when it moves back up, it gradually goes up like a staircase. And I mentioned it on my book. So I think, again, that's why for me, history is really important. And again, I touch upon it in my book as well, that yes, when it comes to time, it's important to be patient, but to also have that kind of historical understanding that through all of the strife that we've seen through previous decades, ultimately the stock market has gone up over time. And I think that's really important to recognize. And just, action bias, like I mentioned initially, is something that, can have a really, dramatic effect and potentially negative effect upon our portfolio. But just take that hands-off, sloth-like, inactive approach and just get on with your life. To take a look back again at my alternative book title, just simply get on with your life. Spend time with your family and friends, pursue your leisure interest, read that book that you didn't get to read over the summer and so on. So just get on with your life,
I like that perspective, because if you're waiting for the comfortable, warm moment to start investing or start anything really in life, you might be missing out on things, going back to the beginning of our conversation, right? And I see investing as something, compared it to breathing. You might not remember that you're to breathe, but you're breathing. And investing, if you're doing nothing with the cash that you saved and it's just sitting at a bank, it's an investment decision by itself. So you can't say you opted out. You never really opt out. The minute you have any savings, you're participating. It's a question, how do you participate? And you propose a certain way to do that. I want to ask you about something that really made me think in your book, and I found it's not discussed enough. And let me frame it the right way. So you talk about the retirement age, let's say 65. But you point out that after that 65 point in time, you still might have another 30 years of life. And the way I'm reading your book is basically, why not use it? In the sense that you've been saving for 30 years and you're 65. It's not that you have to liquidate all, go to cash, treasury bills, and wait for what's next. When I'm reading your book, I'm thinking what you're saying is that you have probably a few more decades of investing. And when you speak about compounding, I do want to remind what our Morgan Housel told us in his book about Buffett, that he made 99 or 98% of what he has today after the age of 65, which is you have to like let it sink in for a second, because we think of Buffett, he's been rich forever. It's true, but he made the hundreds of billions that we look at today just in the age after the 65. So tell me more about that, because I feel like a lot of people are stuck on 65, I retire and I shouldn't be investing anymore. You kind of say the opposite. Hey, keep going.
Yeah, absolutely. Keep going. So it's fun actually. So just to make an analogy to a trip that I took with my family. So we visited several European countries. We actually spent some time in Greece as well. So we were in Athens, one particularly long, hot weekend. And, I don't know about in the States, I guess you had them as well. But in Europe, we have these kind of like hop on, hop off buses. And as a family, we've not ever really taken these hop on, hop off buses before. Athens was so particularly hot this one day, and we knew our 6-year-old would find it really difficult to walk around in the searing heat. So we decided to take on this hop to get tickets for the family on a hop on, hop off bus. And that's great, so we spent a bit of time. It was air conditioned, had a roof and so on and so forth. It's great. We got off, got back on again. We had a 2-day ticket. It was great. And, the thing I'd say though about hop on, hop off, that notion is that I think that's how some people think about investing. So people think that, hey, I'm gonna hop onto this ride. I'm gonna hop onto the stock market. Great, get my returns compound. I'm going to kind of accumulate for many years and so on through the life of my working career. And then the age of 65, 60, 70, whenever you choose to retire, that's when I'm going to going to extricate my money, take up my money, and live off the proceeds of what I've been investing, or what's been compounding. But again, like you touched upon, that is very much kind of an erroneous approach to take. Why would you want the compounding to stop? Yes, certainly. Let's say if you are going to retire at 65, then certainly you may want to take out a significant amount, whatever that may be. But why would you want to, particularly given what you look at in a rearview mirror when you've seen what the stock market has delivered over those successive decades, the 20th century and so on and so forth, the 21st century? Why would you then want the compounding to stop? So I think that's a kind of a foolhardy error. I think it really is. And just going back to that notion of hop on, hop off, actually, I wanted to touch upon it a little bit earlier, but now seems like a good time. It's funny. I was taking a flight this summer, happened to be sitting next to a lovely young person from Croatia who, had never invested before. I got to talk about my book and so on. And she said to me, so how do I know when to get out? So is it after 3 years? Well, how do I know when to get out? And I said, okay. I said, well, let me just take out my hand luggage. Let me take out my crystal ball and the exact moment to take out. No, I'm being facetious. But the point, again, I was trying to make to is that, no one has a crystal ball. We don't know. And, I made a point, look, I happened to have a notebook in my hand luggage at the time. I said, look, on this sheet of paper is a list of people who've been able to predict the best time to get in and the best time to get out. And of course, it was a blank sheet of paper. So the point I was trying to make to her is the fact that none of us know. So again, going back to the point about hop on, hop off, this is something that I think kind of the layperson struggles with at times. Even with previous colleagues, they've asked me, hey, so, it's important to invest. I know that, RP, but when do I get out? And I say, no, you remain invested. And I love that phrase that you used just a moment ago. That kind of long-term, you have to remind me of the investing exponential, what was it?
Infinite investment horizon.
I love that. Infinite investment horizon. So that is key. That kind of infinite investment horizon is key. It's not about getting in, getting out. And again, action bias compels to think it is so, but just to kind of invest for the long term and just remain invested for your whole life. And again, you think about, if you do happen to have children, you think about what it can do for them when ultimately, if someone does pass away, if you've invested for your 70s, 80s, 90s, and so on, then, that ultimately can be something that can benefit them as well. So just invest for your entire lifetime. It's that infinite investment horizon, like you mentioned, which I love as well. I love that turn of phrase. Brilliant.
Thank you. That's how I imagine it, as an infinite kind of pursuit. When I was listening to you, I was thinking about longevity. We're obviously thinking about this money that could serve the next generation, but we're living longer. And I finished reading not long ago the book of Charlie. It's about Charlie White, a doctor from Kansas. It's a book by David Vendrella. It's a real person that lived to 109 years old. And Vendrella gives this beautiful history told through the life of an individual with the backdrop of the US and the world, what was happening. And it was somebody that lived from the early 1900s until, 5 or 10 years ago. But one point that he makes in the book that's very relevant to what we're just talking about is that this character, Charlie, was in retirement as long as some people are in their working years, in their career, which is fascinating to think. And I'm thinking of my grandparents' generation. They have lived many, many decades into retirement. So to pause your investing experience, the hop on, hop off, I think of it as participation, right? To stop participating in the success of the businesses around us at some point in time, it comes at a huge cost, back to your opportunity cost. And if you can see that pool of money as, yes, it will fund my retirement, but it could also be something I can leave behind, kind of opens the door to a whole new way of thinking about that capital. I think it's a much more relaxed way of looking at it, which brings me to another question that I have for you. And I was thinking about it. Somebody asked me, what kind of money would you like to invest? And I called it forgotten money. I actually spoke with Jim O'Shaughnessy, who wrote What Works on Wall Street, and we were talking about it. And I said, Jim, I'm thinking of forgotten money. And he smiled. And I say, well, when you think about the assets that somebody has, I have, there will be some assets that you want to have readily available, right? For monthly expenses, some sudden things, or any plans you have, you're buying a car, whatever it is. But then there's a portion, and you talk about it in your book, that can be committed for at least 5 years. And I want to highlight that because I thought not many people talk about it, but you say 5 years, which is already a huge task. And I love that. I think it's great. But it becomes a bit of a forgotten money you really can forget that it's there because it's invested. You don't need it. There's no claim on it. There are no new ideas for it. House, friend's project. Your cousin is opening a restaurant, needs $500,000. Do you mind pulling it out from, right? It's money that it's just going to be there, forgotten money. But tell me about that 5 years. Why it's so important? Because people, as you said, they have a little bit spare cash left and they think, I'm going in for 6 months, I'll double it, then I'll leave. But that's not at all what you have in mind. 5 years.
Yeah, and I think this ties back to, again, what we mentioned before, just about kind of probability and what the data tells us. So the data tells us that, flip a coin, the 1 year return of the stock market, could be 50-50. I think generally I may be wrong on this, but I think it's something like 54% positive, 46% negative on a yearly basis. And going out the next few years, 2, 3, 4, 5 years, there's a strong likelihood, it's more likely to be positive, but there is still that significant likelihood that it could be negative. So I think if there, like you quite rightly mentioned, if there's perhaps a wedding or, a purchase of a car, or if your cousin requires an investment in their coffee business, whatever it may be, that money should not be invested. If there's critical money that you need, then you need to make sure that it's not invested in the stock market. Yes, while it may just be invested in a savings account, it's potentially not compounding, accruing as much, in terms of overall capital, but you're being more conservative, which I think is the better thing to do. So I just think it's important not to kind of gamble with your money. If you think that like, hey, I'm going to invest this money in the stock market, I'm going to get a good return. The overall return of the stock market's been kind of in that 7 to 10% range over time. So if I invest it over the next 2 to 3 years, I'm going to get a good return. That's not always how it works out. It's not as simple as that. I make the point in my book that yes, while the overall return of the stock market has been between 7 to 10%, the data for the S&P 500 is actually starting, I think in perhaps just 1 year, I want to say maybe just a few years, that return has actually been achieved. So some years it may be 20%, some years 2%, some years minus 4%, and so on and so forth. So the stock market is wildly unpredictable. It really is. So I just do think it's important to be prudent. I do happen to be quite a cautious person by nature at times. Actually, it's funny. We were in Switzerland. My brother-in-law's just secured a job at a British airline, and he's based in Basel in Switzerland. We happened to have a lovely day in the mountains. We went on a toboggan. My brother-in-law, my son were going full belt down a toboggan, going maximum speed, and I was still a little bit, I was applying the brakes here and there. My son was actually making fun of me about it. Dad, you didn't have to put the brake on, it's fine. But I tend to actually be quite a kind of like cautious person at times, by nature. So, and going back to your question, I think it's important for investors to recognize that, yes, over time, over a long-term time horizon, and by that I mean 10, 15, 20 years, the stock market is most likely to yield a positive outcome. Over 1, 3, 5 year time frames, you've got to be a little bit more careful, be a little bit more prudent. So that is key.
I love that. And I'm thinking you talked about the range of outcomes, right? So in each individual year, it can be a wide range. I'm not going to even say, but it could be negative, could be positive.
Yeah.
And the averages don't really tell the entire story. So that's one thing. The second thing is the actual volatility, as in day-to-day movement in your net worth, in the value of your portfolio. And I think that's, you can look at it in many different ways, and I'm curious how you think about it. And there's a quote that I'll mention in a second, but the stock market ownership of businesses is unique in the way that the market offers a minute-to-minute quote on what you have, which is a very uncomfortable and unfamiliar feeling. We don't have that quote even on our car. You have a used car that you've had for 5 years. You're not so sure if they'll take it away from you for 5,000 or 15,000. You don't know, right? Like you just don't know. But the family needs it. You keep the car. So we have so many experiences. We just don't have a price quote. If you have a private business that your grandpa started, like a lot of my clients had, and day to day, they don't know if the business is worth 20 million or 30 million or 50 million. They don't know. They know how much in profits they can expect, but they don't know how much it's worth. The stock market is different because it tells you every minute of the day. And if you have an app on your phone with pings, an alert and all those things, minute to minute, you're feeling like, oh, I'm $500 up. I'm $5,000 down. It's painful. It's physically painful. Yeah. And you have this quote that I want to bring up. You say, seeking to invest without suffering volatility is akin to wanting to drive without experiencing red traffic lights. Tell me more.
Okay, so I happen to be a massive movie fan, actually. It's funny. One of my final days in London, where I just came back from, I went to Waterstones. It happens to be a 5-story building in Piccadilly. It's my favorite bookstore in London. It actually happens to be Europe's largest bookstore. And I don't know what took me that day in that direction, but I bought 2 movie books. One was a book written by Quentin Tarantino, his famous movies, and his most, favorite movies, I should say. And another was just in a general kind of history and cinema. And so listeners of my podcast will know that I love making references to movies. I make several references in the book, like you mentioned, and I happen to be a big Alfred Hitchcock fan. So growing up in UK, my mum was the person that first introduced me to Hitchcock. It was actually the movie Psycho. It must have been about 10, 11 years old. So I don't know what that says about her parenting style. Looking back, I'm thinking, was that a wholly appropriate movie for her to introduce me to? Couldn't have been Vertigo, North by Northwest, never mind. But anyway, so in Psycho, for example, there's, for people that are not familiar with that movie, there's a scene early on where the chief protagonist, the chief character, Marion Crane, she's stolen some money from her employer, from her boss, and she's obviously feeling quite guilty about this. She's attempting to flee the city. I think it's set in Phoenix, Arizona, I think. And she stops at a set of traffic lights. And, she's following the law. She's desperate to get away from the town, but she has to stop, follow the laws of the time, of the road and so on. And she sees her boss as he's crossing the road, and he looks over, but I don't think he quite registers her in the car, and so she's able to get away. Fast forward, I think it's around about 34 years later, Tarantino in Pulp Fiction, released 1994, has a very similar scene with Bruce Willis, his character. And so the point I try to make here is the fact that, whether you're a movie character or whoever you are, whether you're just, driving your own car, if you're in a car, you need to abide by the rules of the road. You need to stop at a set of traffic lights. But eventually that light's going to change and you're going to be able to go on your way, to get on with your journey, arrive at your final destination, so on. Okay. Likewise, when it comes to investing, you just have to be humble, and the stock market is the great humbler. You need to ultimately concede that, the stock market isn't going to go directly up the whole time. Is that volatility? It's an inherent part of the landscape. I mentioned the fact that there are certain parts of the world, certain regions where they just have to become accustomed to particular weather. I happened to visit a place called Naxos in Greece a few weeks ago, and while not as warm as Athens, that was a welcome relief. They have this like really high winds. It's actually quite refreshing on a hot summer's day to have these high winds, and locals were accustomed to that. It was great. And likewise, as investors, you need to be accustomed to the fact that, there are going to be times when the stock market goes up, the stock market goes down. And just going back to what you said there about on a daily basis, and I think you alluded to the fact that is that danger that when you're checking, if you happen to be foolhardy enough to be someone that checks your portfolio on a daily basis, then you are likely going to be someone that succumbs to the fact that you might make a foolhardy decision. And I think this is for me a double-edged sword when it comes to technology. So early on in my book, I talk about the democratization of information, the fact that for me, as someone who comes from a non-investing background, I was able to learn so much through shareholder letters, personal finance books, videos, and so on and so forth to learn and become quite an expert when it comes to investing. Of course, leading to write my book. But ultimately, the negative aspect of that is the fact that, yes, it's just so incredibly easy just to dive into your app. I can, here in Hong Kong where I am, I can dive into my Interactive Brokers app and see the value of my portfolio within 10, 15 seconds. That could be particularly dangerous given this week, early August, what the stock market's been like. So I think while technology has worked wonders for us, particularly when it comes to contemporary investors, you also need to recognize the dangers of kind of like instant access. And that kind of, again, speaks to what I spoke earlier about the fact that we've been conditioned to immediate gratification. So it's important to be cognizant of that.
Volatility is tricky because it can create buying opportunities that would be unheard of in the private market, right? If a family owns a business and they're having a few weaker quarters, they're not running around looking for a buyer. They're thinking, how can we improve the business? But in a public market, there's this anonymous crowd that panics somehow together and gets enthusiastic together. And Ben Graham talked about it with Mr. Market's story that you shared before. And it's tricky. There are two things that I want to mention when you talked about it that made me think that as an investor, you're almost always in below the high. You're below the high water mark. And I notice how it's a tricky place to be because somehow mentally we lock in, especially if it's at a milestone. A few weeks before the recent weakness, one of the clients pointed out how their account with me reached a certain milestone. And I'm always a little anxious about it because you lock in a number in your head. And then for a long time, you might be below that number, but it's some sort of an emotional, almost physical pain that why am I not back to that number, right? Yeah. That's one thing. The second thing that I observed is that if your assets have grown over time or if you inherited assets, it might be the case that a daily movement or a weekly movement in the value exceeds how much you could potentially save and add back to the account with your earning. And I noticed that there's some psychological impact too. Let's say you have $1 million portfolio, right? And you could save 50,000 in a year. After all sacrifices, you could save 50,000, right? And you have a week when your assets drop by 50,000 because of a few weaker days. It has a psychological impact. So anyways, I think the short and quick lesson here is don't check those prices too often because it's not going to help you on the long journey you're on. That's
exactly. And a point I'd make as well to kind of echo what you're saying about losses as well is that I mentioned in my book, so towards the end of the section on Headstrong, chapter 5, my 5th bedrock principle, I talk about 6 cognitive biases. And one I speak about is loss aversion, as not even as investors, but people generally, the experiences that we have when we go through loss, when we experience a loss, it seems to be much, much worse than when we experience a win or a gain. And I think this goes back to Daniel Kahneman, who recently passed away, I think within the last year or so. he spoke about this as well, okay, about what we experience when we feel it. It feels so much more worse when we experience loss as opposed to when we experience a gain. So for, soccer aficionados listening, I happen to be a fan of like Tottenham Hotspur Football Club in UK, and we're not one of the bigger teams, shall we say, certainly not compared to our rivals Arsenal or Liverpool, Manchester United. So as a Tottenham Hotspur fan, I've experienced the pain of loss on many occasions, and I know that actually when I think about those key games of my life, it actually happens to be those losses that kind of come back to me more vividly now than the big wins. And I wish it wasn't like that, but it does happen to be so. So again, that's something I think that investors need to be cognizant of as well, is that the experiences of losses, okay, do happen to be so much more vivid. We experience pain. That pain we experience is more impactful than when we experience, those positive gains. It's interesting. Yeah, I think it's Daniel Kahneman that mentioned this. Thinking Fast and Slow, that's a book. Thinking Fast and Slow. Yeah.
That's very true, that we feel the loss much more. I think some people say it's a multiple of the experience of a gain. And with investing, it's not the actual loss in the sense that you bought something for $100 and now it's worth 50, but the ongoing experience of not being at the high water mark that you have locked in, and feeling the daily movement that you think, could I make it back with my savings? And you realize now you have to let the market earn it back for you. I think there are a lot of little lessons that come with it, but the best one is don't watch it. I want to ask you about something you talk about towards the end of the book that I interpreted as something that's important and that I wrote about. I call it a lifetime of contributions and a lifetime of distribution. So let me explain. So if you can save regularly, which is one of the lessons that I'm taking away from your book, 100 or 1,000 or whatever it is that you can, and you put money into the market. You can forget if the market is high or low. You can just do it gradually, and you can learn as you go. You can even tweak which funds you're using. If you want to have some stocks in it, you can tweak. You have time to learn as you go. But then there's a lifetime of distributions, which is a situation that a lot of my clients face, where they receive an inheritance or they sell a business and a lump sum of money arrives in fairly suddenly. Usually, they're prepared, they think about it, but the actual experience feels very sudden. Here we are, and we have to make decisions. And I say that there's no dress rehearsal here. This is it. It's not like we'll practice with this one and we'll get the second one. It might be the only one in a lifetime, right? And you talk about investing a lump sum. You have some thoughts about it, which I found really interesting, because there are many ways to go about it. Gradually invest it, kind of mimic this other aspect of, gradually putting it to the market, or putting it all into the market. Can you talk about it? Lump sum arrives. What do we do?
Yeah, it's interesting, isn't it? So this is something that I've very much been influenced by an author called Nick Maggiulli. So Nick, you may be familiar with, has written a book called, I think it's called Just Keep Buying. And he mentions it in his book. And he also wrote a blog article about this very question a few years ago. He kind of looked into this. He dug deep into some research articles that explored this question. Is it better to invest a lump sum straight away, or just to kind of portion out, divide that lump sum up, and to divide, to invest over perhaps, 9, 10, 11, 12 month period, and what he found is that generally it is better to invest that lump sum all at once, because if you think about the fact that generally, historically, the stock market has shown us that over time, the stock market has gone up. Well, if you're kind of dollar cost averaging, pound cost averaging, whatever currency you want to use, if you're dollar cost averaging over a 9, 12 month period, for example, it could be ultimately that you are, the shares are costing you more, because over time the stock market has shown that it goes up in a positive sense over time. Of course, there are definitely going to be exceptions to this, and that's not true 100% of the time. It would be foolhardy to think that. But over time, I think the evidence is there to show the fact that it's better to invest that lump sum all at once, as opposed to kind of drip feeding in over 9, 10, 11, 12 month time periods. So, yeah, that's interesting. I think psychologically, psychology comes into play as well. People might think, I invest a lump sum, and then, oh my gosh, the stock market does something dramatic the next day. Yikes, why did I do that? But ultimately, I think Nick, what he writes about in Get Rich Buying and his blog article from a few years before is really interesting. So I think investing in lump sum all at once has actually been proven to kind of be the better approach to take, which is interesting. Yeah.
I'm glad you brought up psychology, because at the end of the day, it's real people, right? And you sit down with them across the table and you can show, look, the statistics would imply this, and the odds of us, participating right away and all that. I can think of so many moments in even the last 2 decades when going all in on blindly on a random day would have been a very bad outcome for the following, 5-10 years. Best case, you have what you started with. So I think having a bit of awareness, what's going on, what's happening. Because when you're making small investments, you kind of can completely ignore. And that leads me to the next question in a second. But if it's a lump sum, I think it's worth pausing for a second and just looking around. What's going on? Is this, how do we feel? And the other thing we talked about, the infinite investment horizon. If you do have that lump sum, remember that you do have probably an infinite investment horizon. You could pause for a second and go in slowly. Sure. It reminds me of a conversation I had with Guy Spear, who in the early days was investing his family money. And he said something that I don't think he mentioned too many times, but in our conversation, we talked about it, how his father had assets in fixed income, in some bonds that would mature at different points in time. And it gave Guy Spear a chance to invest a portion as the maturities came in. And I thought, this is an interesting way of going about it, that you do give yourself a little bit of runway. I'm not saying give yourself 10 years to put it to work, but if you give yourself even 6 months, you and I know that there have been some 6-month periods that look completely different at the beginning and at the end.
Yeah, I would make just another point as well.
Tell me.
I also, in the book about halfway through, I make this point about our investment palette as well, because I really like what you said there about psychology as well. The fact that I think sometimes within the realm of personal finance and investing, there can be kind of camps, whether it's the active management camp, whether it's index investing camp. And I make this analogy to, cuisine, food, and so on. So I happen to be someone in my family who loves spicy food. And if we go out to an Indian restaurant, Dad's likely to be the one that orders a spicy dish. My wife and kids, not so much. And I think similarly, in terms of the fact we have our own unique taste palettes, I think people have their own kind of like personal finance, investing palette, if you like. And I think, you raise a good point there about the fact that ultimately, whatever their data might tell us, ultimately it comes down to investor psychology. What sits best with you? I was reading a fantastic book. The name escapes me now, but it was actually a compilation book. Kind of guest chapters. One was written by Morgan Housel. One was, I think, by Christine Benz from Morningstar.
Collection of articles. Collection of articles. I'm forgetting it, but I remember what you. I think it was called the best investment writing of the. Something.
Yeah, and Housel touches upon this. He touches upon the fact that, I think when he was buying his first house, he didn't get a mortgage. He put all the money in. He wanted to buy outright and so on. And yet there are people, kind of experts, who tell him, no, don't do this, don't do that, and so on. But for him, his wife and himself, that's what just felt about best. That's what felt really good for him, psychologically. And I think fundamentally, you should never underestimate the importance of psychology. So that's why I think I actually love what you said there about psychology. No matter what the evidence may say, or this research from 1992 or whatever, we cannot actually never underestimate the importance of psychology. And ultimately, we want to kind of like sleep well at night. So we have to do what sits best with us as people, first and foremost. Yeah.
I talk a lot about sleeping well at night. No matter how you build a portfolio, if you're not sleeping well at night, think about it again. And I like the question, how does it feel? So I come from a background of, numbers, and I see investing as very technical and scientific, but at the same time, there's a human element to it. It's somebody's money. It's your money. It's your client's money. It's somebody's money. And that money has a meaning, importance, significance in their life. It's much more than just a number on a spreadsheet or a statement. It has some emotional charge to it, and it means something to them. So when we sit down, I like to ask, how does it feel? Like, I want to figure out, how does it feel, and how would a drawdown feel, and how would a bit more volatility feel? And academic, paper that shows me this ideal portfolio, that's one thing, and the actual portfolio that somebody can stay invested in. And I think that's for me the key. Like, what's the portfolio you could stay invested in? Not the portfolio that's optimal for my age and income and statistically where you think I belong. No, what's the portfolio I could actually stay invested in? Which leads me to one of my last questions for you. You have a quote that I really, really like. It says, "Don't try to play a guessing game whether the market is at all-time high or all-time low. You just need to remember to invest consistently." And I feel like it's like the essence of what you're trying to say. But tell me more about that.
Yeah, just, whether the market is at all-time highs or all-time lows, invest with consistency. Again, I think it can be very easy to kind of succumb to kind of what we read in the news. I'm someone, I love to stay abreast of what's happening in the world. I'm very much someone who enjoys current affairs, reading kind of non-fiction books, Time Magazine, Economist, and so on and so forth. But just invest with consistency. And I think it's an interesting point that you made earlier as well about, in a week like we're seeing in the stock market this week, when stocks have been, plummeting and so on and so forth, had that counterintuitive sense that actually stocks are in sell. I think some people see it as the fact that, oh man, I don't want to invest now. Stocks are looking good, but I'm very much someone who advocates what Andrew Hallam states. So Andrew Hallam has written a series of books such as Millionaire Teacher, Balance, Millionaire Expert, and he makes the point in several of these books. He makes the point, well, when we go into our favorite store, we're attracted to the fact that stocks are on sale. Sorry, we're attracted to when products are on sale. Similarly, why would we not be attracted when stocks are on sale? Why would we then not want to invest? Why would we then not want to take advantage of when, an index fund goes down 5-10% in a week or two? So invest with consistency, again and again and again. So, it's going back to that point I made to the young lady on a flight that I took. We don't know. None of us have a crystal ball. No matter how much we might like them, it would make our lives easier. None of us know what the stock market is going to do tomorrow, next week, next month, next year. But just, keep investing. It's not a case of a hop on, hop off scenario. Keep investing with consistency. That is really key. You wouldn't, and again, it comes back to that point about opportunity cost. So, I spoke to someone a while ago, and they said that, when President Trump became president and he's, during his administration, was it now 2016, 2017, they didn't invest for a few months because they were a little worried about how the stock market was going to behave. And I said, but, why would you behave like that? There've been so many, presidents within, the history of the United States. Why would you, I think stock, the evidence has shown us that whether it's, Republican, Democrat, over time, the stock market goes up. So why behave in such a foolhardy way? So just invest again and again and again in that consistent manner, because if you're not doing so, then there's a great opportunity cost to that decision not to.
I would add to it that if anything, the times when you feel the least comfortable to go ahead are probably the best times. In the stock market, because you can get prices at 5, 10, 20-year lows. I'm not saying wait just for those moments, but if you are there participating and you see a moment like that, if anything, maybe add a little bit more if you can. that could absolutely that can help. I mean, all things considering, the situation and a case in time, but historically, the times when people panic have been a good time to buy. I want to ask you about your definition of success, but I do want to bring up one little thing before we get there. We haven't talked about savings. We did, but we haven't. And I just want, I have this visual as I'm listening to you and looking through my notes. I have this visual that and I'm thinking of a plane, a small propeller plane. I fly small planes. That's why a lot of plane images come to my mind. But the engine of the plane is the savings. It moves you forward. But a plane without wings will just go around and taxi around and taxi around. You add wings to it, and that's your investing. And it gives you lift. And that same engine, the savings engine, right? Like there are the statistics that show you save 50,000, but the 50,000 became $1 million because of compounding. Those wings, investing, can let you really rise to levels that you could never imagine. I think that's what really speaks to me as investing. Yes, you save 50,000, but had you invested it would have been $1 million after a few decades, right? that's the staggering thing that I want to bring up before we move to success. Do you have some thoughts about savings?
Yeah.
It's kind of a given. You have to be saving to be investing, but I think it's important to think about it.
Yeah. So that for me was the missing piece for me when it came to personal finance. And sadly, I actually still think that's the missing piece in too many personal finance curriculums. So if I take the UK, my home country, as an example, I read recently that there have been, great improvements made in terms of personal finance and it's being taught in secondary schools, colleges in the UK. But when I actually dived deeper into the curriculum, it actually took quite some time to look at learning objectives and content and so on and so forth. There's, quite a bit that was being taught about savings and debt and a distinguishing between credit cards and debit cards and so on and so forth. But when I actually explored the coverage given to investing, I was kind of distinctly unimpressed. I actually didn't see too much. I just think it's a tragedy, for example, if I were to stop 100 people in the street, perhaps 100 young people in the street in the UK, and I showed them a picture of Jack Bogle, how many could probably tell me who he was? Probably I'd be lucky to get one, if not one. Whereas on the other hand, I make the point about, for example, Colonel Sanders, good old Colonel Sanders, KFC. If I were to show a picture of him, no doubt 95%, if not more, would be able to tell me. So I think it's tremendously sad that not enough people, I make the point in my book earlier on about this, that, too many people in a global population, and include the UK in this, are just undernourished in this regard. I just feel that not enough coverage is given into investing. So I go back to what I mentioned at the very beginning about my father-in-law. So he was someone who spoke to me about investing in my late 20s. And when, to use kind of a phrase, the penny dropped, if you like, when the penny dropped and I realized, that's why it's so important. Look at what the historical return of the stock market has been. That's why it's so important to invest. And I must have been, let's say, 28, 29 at the time. And I look back upon the previous 7-8 years I've been working and the money I'd saved. Yes, I'd had had a nice, healthy amount in my bank account. But I look back and I think, gosh, if I'd been investing that amount, what it could have earned. And I just think, again, opportunity cost. So yeah, I love that analogy of investing being that kind of wing that takes you further, it really propels you ever further, because I think it's so critically important. I just wish personal finance curriculums around the world, whether it's the UK, US, Canada, wherever, could just give more and more coverage to investing, particularly whether it's Jack Bogle, index funds and so on. So I love that analogy that you've given. It's great.
So I have to ask this. I mean, first of all, I think everybody would appreciate having somebody like your father-in-law in their circle, in their family.
Yeah, absolutely.
But I have to ask, what's his story? Why was he interested in investing?
Why was he interested? That's a very good question, actually. I did ask him about that a few years ago. And I think actually he was someone who got started relatively late as well. I think he was in his mid-30s. He was an international school teacher. He's originally from the UK, an international school teacher at Frankfurt International School in Germany. And I think it's just, there was one of his colleagues who just by chance, kind of a serendipitous moment, who got talking to him about investing, who'd been doing quite well in the stock market. And he got speaking to John, my father-in-law, about investing. And I think that kind of initiated a spark in John's mind. And I think that's how it started. And for me, something I touch upon, and I wish I'd written about it in the book, but it's having that presence of mind. I happen to be someone who loves learning about people, even learning about people from fields that I have no particular interest in. So I don't know if you're familiar with Marco Pierre White. He's this kind of like British-Italian chef. He's actually someone who trained Gordon Ramsay. And he did this great talk at Oxford University a few years ago. And you can tell I've watched this talk many times because it's around about the 25-minute mark on YouTube. And he sits back in this chair, leans back. He's got this kind of like tons of books behind him. And he talks about this concept of having presence of mind. And he talks about how, he was fortunate in the early 80s to happen to work in this restaurant with a famous chef. I think it was Guy Roux. And then he happened to kind of stay behind some evenings and listen to the chefs and the tales that stories they would tell and the recipes that they would devise and so on. And he just talks about having the presence of mind. He's speaking to these kind of students at Oxford University about the importance of having presence of mind. He talks about the fact that, you will all be confronted with opportunities. you must take advantage of them. He kind of stresses that point with his hand, like I am now. And again, I think to any young person, it doesn't even need to be about investing, but have that presence of mind within your life. Whether it's a chance meeting with a future mentor, whether it's someone who gifts you a book, whether it's, an informative YouTube tutorial that you come upon, stumble upon by chance, having that presence of mind is key. So I guess, again, without wanting to kind of, blow my own trumpet, if you like, but I guess back when I first started to speak about investing with my father, and when he spoke to me about it, I guess I'm fortunate that I had that presence of mind to have that natural curiosity to want to learn. Because I could have been someone that thought, you know what, sorry, John, I'm not touching investing with a barge pole. My parents have invested. I'm not interested. That's it. But again, I think it comes down to having that humble mindset, having humility. That is key as well. So again, I guess I mentioned optimism, but humility would be another bedrock principle for successful investing and life in general. Yeah.
When the student is ready, the teacher appears.
I love that. Yeah, very much so. I love that. Yeah, absolutely.
And since you and your wife are teachers, I think you know something about appearing in somebody's life and making a difference in their life, as you are both as a teacher and now as somebody that's introducing all of us to investing and showing us that there's a way to do it in a fun way, playful way with the sloth.
Sure.
One last question, because I know it's late over there, so I want to keep you up too late tonight, but I want to ask you about your definition of success. How do you think about it?
It's an incredibly difficult question, and one that I almost feel like I'm not qualified to kind of answer, but it's incredibly difficult. But I mean, when I think about the word success, I think it's about not even so much about achieving mastery, but being good at something and being competent enough. And almost I feel like wanting to devise concentric circles. So we could think about in a very outer concentric circle, there's really big lifetime goals, whether it is writing a book, whether it is, having a successful business, whether it is, achieving a certification to become a lawyer, whatever it may be, and perhaps in one of the smaller concentric circles, we could even just think about, the relationships that we have on a day-to-day basis with friends and so on and so forth. So I think being successful, if I take it down to the granular level, being successful is about, how you treat people, not even, friends and family, but hey, if I'm in a coffee shop, how do I treat the barista? Do I acknowledge them? Do I answer them back? Do I say, hey, how's your day? Hey, if I am in a restaurant and a waiter or waitress, put some food on my table, am I treating them with respect? This is something that I really try to instill my wife and I try to instill in our children. If someone has come over to our table to, give them some food or a beverage, say thank you, express that gratitude. I think that's really important. So I think I interpret success and on many different levels. Yes, that can come down to one's personal values. But I think for me, success very much comes down to all those varying levels, those interactions within life. I really do. I also think back as well, I'm very much guided by truth as well. To what extent is, truth your North Star? So I think back now to a phrase, I think it's by a chap called Václav Havel. He happened to be the leader of Czechoslovakia during the final period of communism in the late 80s. I think Václav Havel is his name. And he spoke about being true to yourself. I'm paraphrasing it. That's not what his exact term was, his quote, but he speaks here about truth. So for me, success comes down to as well, how are you able to, be true to yourself? Or are you someone that kind of is influenced by your in-group, whether it's your family, whether it's your friends, whether it's your kind of group, your tribe within social media, whatever it may be. So I think for me, kind of truth is a North Star, is kind of a guiding star for me. I want to be someone that is able to kind of be true to myself, to not be guided too much by what friends or family say, to have that confidence to be true to myself. So it's a very long-winded answer. I'm not sure how articulate I've been, but ultimately I think success comes down to all those kind of different interactions I have, all those differing objectives I have. I think that's a very long-winded answer. I hope I'm able to answer that well enough.
No, I love it. And I'm thinking kindness on one side
Yes,
and
kindness. Yeah.
authenticity.
Authenticity.
And
Yeah.
Havel was the leader. So I was of Czechoslovakia in the 90s when Eastern Europe was opening up. I was born in Poland, and
Wow.
I grew up in Poland, went to schools around Europe, ended up in New York as an adult. But I remember Havel, and I remember
Yes.
that he said something along the lines that to open your eyes to your own heart, like be
Yes.
your true self. And he was a writer, and he was the one that led the nation and Czechoslovakia at that interesting time. He wrote the book The Power of the Powerless, which was a fascinating read about those times when people were reclaiming their freedom. But I want to share one word about kindness. I came back from Omaha, from Berkshire's meeting last year, and I wrote a piece, and I called it Return on Kindness, inspired by, I think it was Chobani's CEO that talked about return on kindness. And what I felt at the meeting, which is a very unusual meeting. I don't know if you've been to Omaha.
I'd love to go.
I think you would really enjoy it. It's a unique, there are all kinds of meetings that I go to, but this one is just special, and what Buffett creates and Munger at the time too. And when I came back, I thought what I feel is just kindness from everybody. And it's very different than a traditional shareholder corporate meeting. And you feel like you're a part of something bigger, and you feel like you're treated the same way Buffett would treat his sisters invested with him. And I think there's so many ideals behind it that go far beyond what, just making money, that this event permeates and promotes. And I feel like a lot of corporate environments would benefit if we could treat each other a bit better, both the suppliers and the shareholders and everybody else and your employees and all the stakeholders. I think it would be an even nicer place to live in. And I think that's something. If somebody showed us an example, it means that more of us can do it. That's how I look at it. So if Buffett showed us it can be done, I feel like more corporate leaders could take on it. But I love your definition. I love the pursuit of, you talked about curiosity and growth and always finding something else to discover. And I like the fact that you chose to share it with the world. You found it, you discovered it, but you shared it with all of us. So I want to thank you for today. It was such a wonderful conversation. I highly recommend your book and your podcast and your work to everybody. And I feel like you have a wonderful way of introducing all of us to the world of investing. And what better way to have the engine and add the wings to it and really take off. And don't expect that to happen within weeks or months, but think of it as at least a 5-year and hopefully an infinite pursuit. And have fun with it too. And be a sloth.
Absolutely.
Be okay with
absolutely. Yeah. In most walks of life, it's not acceptable to behave in that manner, but when it comes to the field of investing, it certainly is. The evidence is there to prove it. So absolutely. Yeah, it's been a fantastic discussion. I've really enjoyed it. And I just love the fact that as well, we not only touched upon investing, but to kind of circle back to what you mentioned about kindness, we just kind of we touched upon so many, aspects of life itself, whether it's, lifelong learning, curiosity, kindness, and that's what made it a really rich, productive discussion for me, which I really found so beneficial. It's really good.
Well, your book inspired that. You said something about sparks. I think your book will initiate a lot of sparks out there, and I hope this episode only helps those sparks to fly around everywhere we look.
Oh, thank you so much.
Thank you so much for today.
Pleasure. Thank you very much.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.